first thing I would say is with structured products is they're really bespoke products to designed for clients that have different risk appetites. So our own platform is you've got one risk appetite, and we've always assumed the lowest common denominator risk. So if you're going to have all these assets and you're going to move them into the same strategies, you want to be a low risk strategy. But some clients, as I've always maintained, have a higher risk threshold, and some clients have a low risk threshold. And what I wanted to do was be able to offer products to our clients based on their risk thresholds. Like the one of the most interesting things from a regulatory perspective, in the way we assess risk, is that if you're a cryptocurrency holder, you are considered in the highest risk. Like your appetite for risk is extremely high. And so if your appetite for risk is extremely high, we can structure things that actually reduce the risk. We can structure things that actually increase the risk. We can actually structure things that are aligned to your market view. So if you think the market's going to be sideways, how do you generate returns off of that? How do you control your own risk better? How do we educate our clients to control their own risk better and build kind of tailor-made solutions to risk appetite across our community? And there's so many different choices in the way we look at structured products. So obviously you can be fully protected. So you can have like a capital protected product. You can have kind of optimization solutions, which are really designed for investors who have, moderate to a high risk tolerance, who just want to get more efficiency out of their portfolio in flat markets. We've got performance solutions, which are obviously designed to really benefit from directional bets. And for those who've got super high risk, then obviously leverage is obviously something that might be of interest to them. But ultimately, the products that we're launching at the moment, which are, the dual currency, which is a kind of staple in currency markets, the range accrual, which is when you want sort of looking at something in more stable markets, so you can accrue yield based on markets trending within a range. We have a shark fin, which is based on a kind of directional view. And we have a target, which is a product designed around a level in the market that you're comfortable with. But the names of structured products generally reflect their the shape of the payoff in the profile of that product. So there are obviously a lot of things that we can build on top of this, but the basics that we start with, obviously the shark fin is directional, the dual currency, which is efficient, optimization, range obviously is what it says on the tin, and target, which is based on a view. So the broadest differences, if I really want to break it down in the most simplest form, is risk appetite and market view. If you believe that markets are going to be stable, obviously you want to accumulate yield as much as possible, because you're not, if you were to track a normal distribution of outcomes in asset prices, then you're picking a piece or a part of that normal distribution curve and saying, I want to earn in this range. And because you've given up the returns in the outside of that range or outside of that particular area on the normal distribution, you get paid for that. And that's where the yield is generated from. It's like, I don't mind missing out on all of this upside, but I want to earn this much from this product, or I want to protect all of this downside. So the payment for that is I'll give you some of this upside and I'll just play within this sweet spot. So there's lots of ways we can look at this. So so each scenario based on your risk appetite and probability of the event happening generates the yield. So ultimately you're saying, what is the likelihood of this event happening? And the risk-free market neutral price and the arbitrage-free price will give you a yield based on the volatility of the underlying. And that's how we price. And so you can get yields out to triple digits if you're taking huge risk, and you can get really low single-digit yields if you just want to just trickle along and have more control over the way you earn on your portfolio. So I mean that's I think is the best of an explanation I can give you, Akash.